Okay, let's dive right into this explainer and completely unravel the single most widespread illusion in American personal finance. Today, we're looking at a huge financial mystery that's playing out right now, literally right in front of us, and it affects almost every major financial decision you are ever going to make. You see, for decades, we've all been fed this very specific story about how money works, right? The story goes, when the Federal Reserve lowers its interest rate, the rates in your life, especially your mortgage, just naturally follow it down. Poof, cheaper borrowing. But here's the thing, that story, it's fundamentally broken.
Just think about the sheer paradox of what's happening. We recently watched the Federal Reserve cut its rates significantly. Over a recent period, they eased by a full 175 basis points. That's 1.75 percentage points. So naturally, you'd think your mortgage rate would just plummet, right? But instead, the average 30-year fixed mortgage actually went up to 6.65%, which was higher than it was a whole year prior. The Fed went down and mortgages went up. So why did your 30-year mortgage rate completely ignore the most powerful central bank on earth?
To really get this, let's look at the reality for guys like Curtis and Ryan. So Curtis, he bought his house at a rate he really wasn't happy with, and he's been waiting 18 months. He tracks every single Fed meeting, he knows the exact dates, he even kinda knows the voting members. When a rate cut is finally announced, he opens his laptop, pulls a refinance quote, and literally nothing. The quote barely moves at all. He shops around, totally assuming his lender's ripping him off, only to find every single lender's quoting the exact same thing. He, just like millions of other Americans, has been obsessively watching the wrong number.
Let's jump straight into Section 1, the floor, not the dial.
To solve this whole mystery, we first have to understand what the Federal Reserve actually does. Because I'm going to let you in on a little secret. There is no magical dial in some smoky room in Washington, D.C. that commands all interest rates down. What the Fed actually does is set a target for one very specific interest rate, known as the federal funds rate. And this is strictly the rate that banks charge each other to lend money overnight. We are literally talking about money that's borrowed after dinner and returned before breakfast. And the crucial point here is that the Fed doesn't even dictate this overnight rate by law. They do it through a massive irresistible offer. The Fed essentially pays banks interest, say 3.5 to 3.75%, just to park their cash at the Fed, doing absolutely nothing, zero risk, zero effort. It's basically the ultimate dream job for a bank. If the Fed gives you that incredible deal, why on earth would you take on the risk of lending to another bank for less? So the Fed acts as a giant checkbook, flooring the price. And this power works beautifully for short-term, overnight things, because that money has literally nowhere else to go.
Which brings us to Section 2, the snapped chain.
Let's see how this all builds out, because your mortgage is a massive 30-year commitment, not an overnight loan, right? What money is worth tonight is a vastly different question than what money will be worth in 3 decades. Think of interest rates as a heavy metal chain. That first link, the overnight rate, perfectly follows the Fed. But as you stretch that time horizon out, the links completely weaken. 3-month bills follow pretty closely. 2-year notes? Well, they follow loosely. But by the time you get to 10-year notes, they barely follow the Fed at all. And a 30-year bond, that's practically in a different universe. Your mortgage is actually priced off the 10-year Treasury note plus a spread, historically around 192 basis points. When the 10-year moves, your mortgage moves. But when the Fed moves, your mortgage just kind of shrugs.
Now you might be wondering, why didn't we notice this before? Well, for 4 decades, you really didn't need to. Historically, whenever the Fed began cutting rates, long-term yields fell roughly 100 days later. Not because the Fed forced them to, but because the Fed usually cuts rates when the economy is weakening. And a weakening economy means lower inflation, so investors look for safe havens, happily accepting lower yields. For 40 solid years, this rule was practically law. But then came September of 2024, and that 40-year correlation completely shattered.
Just sit with this for a second. The Federal Reserve aggressively eased its policy rate by 100 basis points. Yet during that exact same window, the 10-year Treasury yield did the exact opposite. It rose by 99 basis points. The rate the Fed controls went one way, and the rate that actually prices your life went the other. That is a massive 200 basis point divergence. This was the exact moment the chain visibly snapped, proving without a doubt that the Fed does not set your long-term rates.
Let's move on to Section 3, the invisible bond market.
Since the Fed doesn't set your long-term rate, we need to look at who actually does. And spoiler alert, the answer isn't some secret society or hidden hand. It happens right out in the open, in the U.S. Treasury bond auctions. The U.S. Treasury borrows money by holding auctions every single week. They announce they need to sell a certain amount of 10-year notes, and buyers literally show up to bid what they're willing to pay. So who are these buyers? Surprisingly, it's pension funds that need safe assets for retirees, it's life insurance companies, foreign central banks, and indirectly, it's actually you and me,
through our retirement accounts. Your mortgage rate is determined by millions of small, private answers from these buyers at a highly public auction every single Tuesday.
Here's the catch. When these buyers lock up their money for 10 or 30 years, they demand extra compensation. In the financial world, this is called the term premium. It's essentially the extra yield they demand to cover all the crazy things that could go wrong across the sheer unpredictability of the future. And here's the ultimate reality check for us. When this premium climbs, your mortgage rate climbs right along with it, completely regardless of what the Federal Reserve does.
So why did this term premium spike so aggressively in 2024, snapping that chain we talked about? It all came down to three massive forces that the Fed simply can't control with a little overnight rate. First, we had a massive supply of government bonds. Second, there was fierce competition from AI tech companies issuing their own highly attractive corporate debt. And third, lingering inflation. It made lenders seriously doubt what their dollars would actually be worth in 20 or 30 years.
To truly grasp the sheer scale of that first point, the supply issue, you've got to look at the numbers. The United States just crossed $40 trillion in national debt. $40 trillion! In a single month recently, the federal deficit ran $432 billion. And every single dollar of that has to be borrowed at auction. When you flood the market with that much supply and demand just doesn't keep up, prices inevitably fall and yields climb. That isn't some targeted policy choice in Washington. That is just brutal, unavoidable arithmetic.
The government actually tried to fight this, believe it or not. When the 30-year Treasury yield hit 5.33%, which was the highest since 2007, the Treasury tried stepping in as a buyer to push yields down, utilizing a $4 billion buyback operation. And it worked for about 48 hours, before the market completely erased the move. Why? Because comparing $4 billion to $40 trillion is just staggering. If you scale that down to a normal household, it's the exact equivalent of carrying a $10,000 credit card debt and bravely making a $1 payment. The market just saw right through it.
The bond market pushed back and won the argument in plain sight. It keeps the government on this perpetual hamster wheel, and it's largely because the government is borrowing massive amounts of money just to pay the $1.2 trillion in interest on what it already owes. This is exactly why the Federal Reserve recently stopped using forward guidance, which was their old trick of trying to talk down the markets months in advance. An institution that stops promising where rates are going is an institution that has quietly accepted it no longer controls the destination.
Okay, bringing us to our final part, Section 4. What actually lowers rates? So, what does this actually mean for us everyday consumers? It means we need a totally practical shift in how we manage our financial lives. It means following the lead of people who realized the old rules were broken, who deleted their Fed meeting calendar, and now strictly watch the 10-year Treasury yield. That is your true anchor. If the Fed cutting rates isn't the savior, what actually is? Well, there are really only three genuine ways long-term yields fall. 1, Congress issues fewer bonds, meaning less borrowing. 2, inflation genuinely and permanently cools, causing that term premium we talked about to shrink naturally. Or 3, a painful economic recession hits, terrifying investors so much that their money runs blindly toward the supreme safety of U.S. Treasuries, driving yields down fast. Which brings us to the absolute most important takeaway of this entire explainer. We have to stop timing our financial lives around 8 scheduled Fed meetings a year. Instead, look at the cold, hard reality of the bond market and ask yourself this final, absolutely crucial question. If you are delaying a massive life decision, just sitting on the sidelines hoping for long-term interest rates to plummet, which of those 3 economic scenarios are you actually rooting for? Because historically, the most reliable way rates come down is the one that arrives with widespread job losses attached.